Everybody, welcome to Intermediate Accounting 17th edition video walkthrough for Kiesel, Weingart, and Warfield. This is problem 14-3. The textbook authors are Don Kiesel, Jerry Weingart, and Terry Warfield. The question used in this presentation is 19 by John Wiley and Sons. All rights are reserved for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 through 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or Wiley. Okay, so let's go through and have some fun. Okay, so we're now doing problem 14-3. This is negative amortization. So Good Deal developed a new sales gimmick to help sell its inventory of new automobiles. Because many new car buyers need financing, Good Deal offer a low down payment and low car payments for the first year after purchase. It believes that this promotion will bring in some new buyers. Okay, so on January 1st, 2020, the customer purchased a new $33,000 automobile, making a down payment of $1,000. The customer signed a note indicating that the annual rate of interest would be 8% and that quarterly payments would be made over 3 years. For the first year, Good Deal required a $400 quarterly payment to be made on April 1st, 2020, July 1st, 2020, October 1st, 2020, and then on 1/1/21. After this 1 year period, the customer was required to make regular quarterly payments, would then pay off a loan as of January 1st, 2023. So let's go ahead and write out all of the dates. Okay, so the amount that's being financed is going to be $32,000. Okay, so amount is going to be 32 grand and payment so there's going to be a total over here of 12 payments. So over here on 4/30/20, indicate the amount the customer owes on the end of the contract at the end of the first year. So on 4/30/20, right? So the amount, the carrying value of the note is basically at $32,000. The payment is I'm requiring $400 to be made on April 1st. And is this on, did I screw that up? Oh yeah. This is 4/1/20, 4/1/21, 4/1/22, and there we go. Okay, so we're all good to go. Okay, so right over here for the first year, basically what I'm going over here and doing is I'm essentially saying that, okay, the amount of the payment is going to be $400 for the first year. And then after this payment period, then there's going to be where this is the amount that we have to sit down and try to figure out. Okay, so right over here on the amount, my interest rate is going to be how much? Well, it's basically going to be 2%, right? Where's the 2% coming from? 8% annual rate divided by 4, 2% quarterly rate. Okay. So right over here, my interest expense is going to be 32,000 times 2% or 640. However, my payment is not even covering the interest. So my difference over here is basically going to be at 240. Okay. And this over here, this could be my interest revenue, because I'm doing this from the perspective of the dealer. So my ending carrying value is going to be 32,000 plus 240, or 32,240. Why is it going up? Well, the interest rate is at 2%, and this is not going to be changing throughout the life of the note, right? So this is not going to be changing. But what's happening here is that if I look at this, my interest, the payment that the customer is making is not even covering the interest amount. So that's why you're seeing that. Why is my carrying value increasing? Well, my carrying value is increasing because I have this issue over here with, basically I have this issue with the ending, basically with this ending carrying value going higher because the interest payment is not covering the amount of the interest. So for the following period, we're going to get into a similar situation. And so for the first year, what ends up happening is that my carrying value is actually, or what the customer owes me, the payments they were making were not even going through and covering the base amount of the loan. Okay. So over here, I've got 1, 2, 3, 4, 5, 6, 7, 8. Okay. So indicate the amount the customer owes on the contract at the end of the first year. So the customer would owe $32,989. So the next thing that we're being asked to go through and to do is to compute the amount of the new quarterly payments. Now, for the new quarterly payments, this is kind of like an internal rate of return type of question. What is going to be the present value factor, which is going to essentially make this go down to 0? Right? What is that internal rate of return? Or what is going to be that? How do I figure out the payment amount from here? So the amount that's owed is going to be $32,989. Okay. So what we're trying to do is we're trying to say that this equals what? This is going to essentially equal the amount of the payment times basically a present value factor, which is going to be the present value of an ordinary annuity of $1. And this is going to be 8 periods at 2%. Okay, so if I took the amount of the payment times the present value of an ordinary annuity of $1, 8 periods at 2%, that should equal $32,989. And how do I know I have 8 payments? 1, 2, 3, 4, 5, 6, 7, 8. Okay, so if I go to present value of an ordinary annuity of $1, I have 8 periods at 2%, or 7.32548. Let's make sure I got that right. 2%, 7.32548. Okay, equals the amount owed. So over here, basically the payment amount is going to be $32,989 divided by 7.32548. Okay, so this is going to give me a payment amount of $4,503. Does this work? I have no idea. So If I change my payment though to be 4503, and if I leave this constant throughout, let's go ahead and now see what happens down here with our carrying value. Okay, so this works. Okay, so I've got over here. So the payment is going from $400 to 4503. And then instead of negative amortization, meaning increasing my carrying value, it now starts to go through and to decrease it. So as I look through this particular question, this is interesting because it does involve a little bit of managerial accounting. This is something we cover in one of the later chapters. So right over here, indicate the amount the customer owes on the end of the first contract year. Compute the amount of the new quarterly payments. Well, it's going to be 4503. Prepare a note amortization schedule for these new payments for the next 2 years. So we just did that. And then what do you think of this new sales promotion used by Good Deal? Well, the first issue you're going to have is that the new deal would need to be, or Good Deal Inc. would need to be disclosing to the customer that this is, you're going from $400 to $4,500, and that's like a mortgage, right? This is a pretty high dollar amount for a car purchase. So this, to me, it sounds like it's kind of like a bait and switch. It's almost like you're just kind of renting the car, and then this is what's happening if you actually want to try to go through and own it. So again, what I would say is that as you're looking at this particular situation, what you see over here is like, okay, the payment, it's essentially the payment's jumping from 400 to 4503 because given the shortened time period, this is what's happening. So what do I think of the new sales promotion? It's not good for the customer, and you're probably going to get on some kind of a reality TV show or like one of those news organizations, one of those news programs on, fight back consumers, right? So again, when we look at this, the best way to do these questions, in my opinion, is to go through and to write out the payments. Now, if you were taking my class and if I was teaching this class, could I make you do this without Excel? No, this would kind of be torture, but it's important that you know how to go through and to compute these different types of questions. So that is our video for today. And I want to thank Wiley for allowing me to use their materials. Don't forget to like and subscribe if you would like other solutions. Please feel free to ask for them in the comments. Have a great one, and I look forward to seeing you on the next video. Have a good one.